All right, let's grab our magnifying glass and dive into the latest earnings report from cloud monitoring company Datadog. We're going to treat this like a detective case. We've got the financials, we've got the executive testimony, and our job is to piece it all together and figure out what's really going on.
So, the first clue drops right on our desk. A headline number showing revenue is up 28% year over year. Now, on the surface, that looks amazing, right? But any good detective knows the first clue hardly ever tells the whole story. So, where do we even begin?
Well, you follow the money. It's the oldest rule in the book. So, our first step is to trace exactly where that impressive 28% growth is coming from. Let's dig into the customer files and see if this strength is spread out or if it's just a one-off lucky break.
And here we go, our first real lead. The revenue isn't just coming from one place. Nope. It's split between two very different groups. You've got the flashy, fast-growing AI native companies. They make up about 12%. And then you have the much bigger, more traditional customer base, the other 88%. These are the two key witnesses in our case.
Now let's put that huge 88% slice of the business under the microscope. What's so interesting here is that their growth is actually speeding up. It went from 18% last quarter to 20% this quarter. This is a really powerful clue. It tells us the company isn't just riding the AI hype train. Its core business has its own seriously powerful engine.
And the evidence just keeps piling up. I mean, look at this. Bookings from brand new customers more than doubled. The number of big spenders, we're talking customers paying over $100,000 a year, that grew by a really healthy 16%. And get this, their existing customers are going deeper, with almost a third of them now using 6 or more products. The revenue story looks rock solid from every single angle.
Okay, so the revenue story checks out. Case closed, right? Not so fast. Just when we think we've got this all figured out, our investigation hits a massive plot twist: profitability. And this is where things get really, really interesting.
And here it is, the central mystery of our case. How on earth can the exact same company report both a $6 million operating loss and a $207 million operating profit in the very same quarter? One number says they're in the red, the other says they're printing money. This isn't a typo, folks. This is the most important puzzle we have to solve.
The smoking gun is right here, staring us in the face on this reconciliation table. Official accounting rules, that's GAAP, show a loss. But the company also reports this other non-GAAP profit. The difference? Well, they add back a few things that aren't cash expenses. And the main culprit, the big one, is over $200 million in stock-based compensation. That's paying employees with equity instead of cash. And understanding this is the key to cracking the entire case.
So now we turn to the earnings call transcript. Think of this as our chance to get management in the interrogation room. We've seen the numbers, now let's see if their story holds up under some tough questioning from Wall Street analysts.
The CEO, Olivier Pomel, he opens with a really confident statement. He confirms those broad-based positive trends we uncovered when we were following the revenue trail. His opening testimony, it lines up perfectly with what we've already found. But analysts, they're not just going to accept a high-level summary. They start pressing for specifics. Sanjit Singh from Morgan Stanley here basically asks, okay, but why? What are the real drivers behind all this growth you're seeing?
And the CEO, he delivers. He gives 3 concrete specific drivers: a good market, the fact that they've been hiring more salespeople and it's starting to work, and that their products are just flat out resonating with customers. This takes his story from a general alibi to a specific, totally credible account. So far, the testimony checks out.
Okay, so the story is consistent. We've got strong top-line growth driven by broad demand, and we have a clear explanation for those weird profitability numbers. But for our final piece of evidence, we're bringing in an expert witness, a powerful metric called the Self-Sustainable Growth Rate, or SSGR.
So, in plain English, what is this thing? Well, think of it as a test to see if the company's growth engine can run on its own fuel. It measures how fast Datadog can grow using only the cash profits it makes from its operations without having to issue more stock or take on any new debt.
So, after running all the numbers from the financial statements through our lab, the results are in. Our calculation shows that Datadog's self-sustainable growth rate is about 4% on an annualized basis. That's kind of like the speed limit for its growth if it were only using its own profits.
And this, right here, is the most revealing clue of all. There is a massive 24-point gap between the 4% growth Datadog can fund itself and the 28% growth it actually delivered. So what's bridging that huge gap? It's that $200 million in stock compensation we uncovered earlier. That's the rocket fuel they're pouring into the engine.
And with that, the investigation is closed. We've examined the evidence, we've interrogated the witnesses, and we've consulted our expert. It's time to step back and deliver the final verdict on the case of Datadog's third quarter.
So here's the crucial point, the bottom line. Datadog is an incredible growth machine. The core business is strong, customers are happy, and it's generating plenty of cash. But, and this is a big but, that growth is being heavily subsidized by shareholder dilution. They're funding it by issuing new stock to employees, not by its own profits. This isn't some dirty secret. It's a very deliberate, classic, high-growth tech strategy.
And that leaves us with one final provocative question that really frames the entire investment thesis here. Datadog is trading a piece of the company today for market share and blistering growth, betting that it'll all translate into massive, real GAAP profits down the line. The case of what they're doing is closed, but the real mystery, when that bet finally pays off, well, that's still unfolding.